All right, let's get into it. Today, we're talking about a real titan of the banking world, HDFC Bank. For years, this was an institution that just seemed, invincible. But after a massive merger, this giant faced its biggest test yet. It forced them to make a decision that honestly stunned the market. This is the story of why they hit the brakes and what their playbook for a powerful comeback looks like.
And that really is the central question of our whole explainer today. It just sounds completely backward, right? Why would a bank that's famous for its relentless growth suddenly, and on purpose, slow itself down? Well, to figure that out, we first have to understand what made the bank so powerful in the first place. You see, to get why slowing down was such a shock, you have to realize what HDFC Bank was for decades. It wasn't just another bank, it was the benchmark. Investors literally called it the fortress because of its incredible stability and just its clockwork-like performance year after year. To really get what makes HDFC Bank tick, we need to talk about its economic moat. It's a great term. Think of it like a protective barrier, right? A set of deep, structural advantages that just walls it off from competitors. It's this moat that let it dominate for so long. So what are the pillars holding up this fortress? Well, first off, just incredible brand trust. People simply trust HDFC Bank with their money, and that creates fierce customer loyalty. This trust lets them attract this huge river of low-cost CASA deposits. That's just money sitting in current and savings accounts, which is basically super cheap funding for the bank to lend out. You combine that with a massive branch network, top-notch technology, and a risk management system that is just second to none. And this image, it really drives home that point about the brand. This isn't just a logo, it's a symbol of safety and trust for millions. And that trust, it translates directly into a massive financial advantage. When people trust you, they give you their money at a lower cost than your rivals, and that just fuels higher profits. Simple as that. But then came a shock to the system, a truly monumental event that would test that fortress like never before. The massive merger with its own parent company, the housing finance giant HDFC Limited. And the merger had an immediate and, let's be honest, a deeply worrying result. It all came down to this one single shocking number that popped up on their balance sheet, 110%. That number is the bank's credit-to-deposit ratio, and it had just skyrocketed into the danger zone. So what does that actually mean, and why was it so alarming? Okay, the idea here is actually pretty simple, but it's one of the most critical vital signs for any bank's health, the credit-to-deposit, or CD ratio. It's exactly what it sounds like, and when it goes over 100%, a big red warning light starts flashing on the dashboard. It meant that for every 100 rupees HDFC Bank held in customer deposits, it suddenly had 110 rupees out in loans. That puts a major strain on its cash. So the bottom line is this. The merger instantly created a huge imbalance. The bank swallowed a massive book of loans, but it didn't get a matching base of deposits to go with it. So management was facing a really clear and urgent problem. And their solution? It was radical. Instead of trying to grow their way out of the problem, which would have been really risky, they chose to just take their medicine. They kicked off a deliberate and what turned out to be a pretty painful slowdown. So how'd they do it? Well, they created a deliberate mismatch. On one side, they basically slammed the brakes on giving out new loans, slowing that growth to a crawl at just 7 to 8%. But on the other side, they kept their foot on the gas for deposits, which kept growing at a really healthy 12.1%. See the strategy? More money coming in, less money going out. That was the entire game plan. And did it work? Oh yeah, absolutely. This chart tells the story perfectly. That C/D ratio, which spiked to a dangerous 110%, has been successfully wrestled back down to the 95 to 96% range. They are now well on their way to their target of a super healthy 87 to 90%. But here's the catch, right? The market, it hates seeing a growth champion slow down. Investors, who were so used to HDFC Bank growing at 15% or more, saw this deliberate slowdown and they just punished the stock for it. So this prudent, totally necessary move was really unpopular in the short term, and it led to the stock seriously underperforming. So, now that the balance sheet is stabilized, the focus is shifting to the future. And management has been crystal clear that this slowdown was always a temporary fix. They've laid out a detailed, multi-year roadmap to get that growth engine firing on all cylinders again. And here's that comeback plan, laid out for everyone to see. Fiscal year 25 is all about finishing the repair job, so conservative growth. Then, in fiscal 26, they plan to get back in the race, matching the industry's average speed. But the real pivot point, the one to watch, is fiscal year 27. That's when they plan to hit the accelerator and once again start leaving their competitors in the dust.
So during this whole transition, what does the bank's health actually look like? Well, the numbers show that the core engine is still rock solid. Even with the slowdown, net profit is still growing nicely. Asset quality, which is basically their percentage of bad loans, is excellent and is actually getting even better. And their capital cushion, it's nearly double what regulators require. I mean, that is an exceptionally strong position to be in.
Now, this is where the story gets really, really compelling for investors. Despite its best-in-class reputation, its history, just look at its valuation. Its price-to-book ratio is hanging around 2.8, which is actually a little bit less than its top rival, ICICI Bank. The market is pricing this fortress like it's just any other castle. And this quote from the source analysis just sums up the whole thesis perfectly. The argument is that the market is so focused on the temporary, strategic slowdown that it's completely missing the reacceleration that is now clearly on the horizon. So we end right where we started, with a question. After navigating a massive merger, deliberately taking its medicine to fix the balance sheet, and laying out a clear path back to growth, is HDFC Bank a case of a truly premier, best-in-class company being temporarily offered at a merely average price? That's the comeback playbook we've explored today.